Ever wondered why some money you receive just isn't taxed? It feels almost like magic, right? But here's the secret. It's actually by design. We're talking about income exclusions, specific amounts of money or benefits you get that, well, for various reasons, the tax system says, nope, not taxing that one. Today, we're diving deep into the world of gross income exclusions, using some comprehensive tax guides and research as our map, our mission, to really demystify what these exclusions are, why they exist, and how knowing about them can genuinely impact your financial life. Think of this as your shortcut to being truly clued in on where those tax-free advantages might be hiding.
And understanding exclusions, it really isn't just for tax pros. It's about recognizing when an increase in your wealth, maybe something you receive, isn't actually considered taxable income. This lets you optimize your financial planning. It helps you grasp the subtle but really significant differences in how various kinds of income are treated. And frankly, it helps you spot opportunities that most people just overlook.
Get ready for some aha moments, because we're going to unpack everything. Things like gifts, life insurance payouts, scholarships, health benefits, even those sometimes confusing employer perks. Let's dig in. Okay, let's start with a fundamental distinction. What's the difference between something that's not income at all versus something that is income, but then gets excluded from your taxable amount? It sounds technical, maybe a bit like splitting hairs, but it's crucial.
It really is, yeah. Think of gross income as this big bucket, right? Everything that could potentially be taxed goes in there initially, but some things, they never even make it into that bucket. They're just not income to begin with. The classic example, borrowing money.
Ah, like a loan.
Exactly. When you get a loan, your net worth doesn't actually go up because you've got this offsetting liability. You have to pay it back. So you get cash, but you owe cash. It's a wash, not income. Same idea with, say, a return of capital. If you're a shareholder and the company gives you back part of your original investment, that's not income either. It's just getting your own money back.
Okay, so that's not income. What about exclusions then?
Right. An exclusion applies to something that would normally be income. It did increase your wealth, but then a specific tax rule comes along and says, okay, we're pulling this out of the bucket before you calculate tax. These are usually laid out in specific sections of the tax code, section 101 through 140, for example. They deliberately remove certain items from taxation.
So why do these exclusions even exist? Are they just, I don't know, random loopholes someone found?
Oh, not at all. Well, usually not. There's typically a clear legislative reason behind them. Many are tax relief measures, maybe helping people after a disaster, Others are designed to encourage specific activities like saving for college or getting health insurance. Sometimes it's about the design of the tax system itself. Or practical stuff, maybe the IRS decides taxing tiny, hard-to-measure benefits just isn't worth the hassle.
Okay, that makes sense. Here's an interesting one from the corporate world you mentioned. Stock dividends. If you get more stock, usually no tax right away, your cost basis just changes.
Correct.
But what if the company gives you a choice? Like, you can have this dividend in cash, or you can have it in stock. Does that choice itself change things?
It absolutely does, big time. If a shareholder has that option cash or stock, they've realized gross income, period. Doesn't matter which one they pick.
Wow.
Yeah, the mere availability of the cash makes the whole thing a taxable event, even if you end up taking the stock. That choice is key.
Okay, let's shift gears. Gifts and inheritances. We often hear they're tax-free. Is that always the case? And what really counts as a gift to the IRS?
Generally, yes. The value of a gift you receive during someone's life, or an inheritance or bequest you get when someone passes away, that's usually excluded from your gross income as the recipient. But the crucial part is the donor's intent. For tax purposes, a gift has to be made out of affection, respect, admiration, charity, or impulses, but basically generosity with no strings attached.
No strings attached. That sounds like where it could get tricky.
Exactly. The challenge comes if the person giving you something also does business with you. Then it gets really hard to prove it's purely a gift and not, disguised compensation. There was a famous case, Robertson v. U.S. A composer won a cash award for a piece of music. The court said it was taxable because it stemmed from a contract, fulfilling an obligation, not just a spontaneous good job gift.
Ah, so if there's a contract or an expectation of something in return.
It's almost certainly not a gift for tax purposes, even if it feels like a prize or a bonus. That quid pro quo element makes it income.
So applying that, even if my boss gives me a thank you bonus and they say it's pure generosity, the IRS is still going to see that as compensation.
100%. Employer payments to employees are never treated as excludable gifts. Doesn't matter what the boss's motive is, it's always considered income from your job. That's a really common mix-up. Now, employee death benefits, those are a bit more complex. Voluntary payments from an employer to a deceased employee's family might be gifts or compensation, depends on the facts, but any income the employee had already earned but hadn't received yet. That's income in respect of a decedent, and it is taxable to whoever receives it.
Okay, got it. Let's talk about another big one, life insurance. When someone passes away, the payout to the beneficiary is usually tax-free, right?
That's the general rule, yes. Proceeds paid out by reason of the death of the insured are excluded from the beneficiary's gross income. It's a fundamental protection, similar in principle to getting an inheritance tax-free.
But what if you need that money before death? I've heard about accelerated death benefits. Can you tap into your policy tax-free then?
Yes, and this is a really important, compassionate part of the law. If you're certified by a doctor as terminally ill, meaning expected to pass away within 24 months, you can receive life insurance proceeds before death, and the gain, the amount over the premiums you paid, is excluded from income. And there are no strings attached on how you use those funds.
Okay.
Now, for chronically ill taxpayers, people who need help with daily living activities, they can also get accelerated benefits and exclude the gain, but those funds must be used for qualified long-term care expenses.
That's a key difference then, the use of funds for the chronically ill.
It is, and it's totally different from just surrendering your policy for its cash value while you're healthy. If you do that, any gain the cash value minus your total premiums paid is taxable income. So if your policy's cash value is $25,000 and you paid $13,000 in premiums, cashing it in means $12,000 of taxable income. The accelerated benefit rules recognize that critical need when facing severe illness.
It really shows how the law tries to provide specific relief in these very tough circumstances, treating the funds differently based on why and when you receive them. That's a crucial insight for anyone with life insurance. Let's talk education. It's incredibly expensive. What kind of help, like scholarships, can students get that isn't taxed?
Okay, scholarships. If you're a degree candidate at an eligible educational institution, the scholarship money is generally excludable from your income. But, and this is a big but, only the portion used for qualified tuition and related expenses.
Qualified meaning?
Meaning tuition, fees, books, supplies, and equipment that are required for your courses. Here's the kicker. Room and board costs cannot be excluded under the scholarship rule. That part's still potentially taxable income if the scholarship covers it.
Ah, okay. So the money for textbooks, maybe lab fees, that's tax-free, but the money covering my dorm room or meal plan isn't.
Exactly. That's a critical distinction for students and families budgeting for college. Also, if the scholarship is really payment for services like being a teaching assistant or research assistant, unless it's specifically structured as a qualified tuition reduction, then that payment is taxable, even if they call it a scholarship.
Got it. So labels don't matter as much as what the money is for and whether you had to do something for it.
Precisely.
Life throws other curveballs too: accidents, illnesses, natural disasters. How does the tax code handle payments you might receive to help you recover?
There are specific rules here, too. Generally, damages received for physical personal injury or physical sickness are non-taxable. That's true even if those damages replace income you lost that would have been taxable, like lost wages from being unable to work.
Okay, physical injury, non-taxable. What about emotional distress?
That's where it gets different. Compensatory damages solely for emotional distress are generally taxable. The exception is if those damages pay for medical care specifically related to that emotional distress. And punitive damages, amounts intended to punish the wrongdoer, are always included in gross income. No exceptions there.
Always taxable for punitive.
Okay. Beyond that, there are other specific exclusions for hardship situations. Things like damages for wrongful incarceration, workers' compensation benefits are excluded, and qualified disaster relief payments money to cover personal, family, living, or funeral expenses resulting from a federally declared disaster. Those are generally non-taxable. Also, insurance payments for extra living expenses if your home is unusable because of a casualty, those can be excluded too, up to certain limits.
So when settling a claim or receiving an award, understanding if it's classified as for physical injury, emotional distress, or punishment is absolutely huge for your tax outcome.
Right. Let's move into the workplace. Beyond salary, employers offer tons of benefits. Health insurance is a big one. How does that fit into this exclusion picture? Employer-sponsored health plans are a prime example of a valuable exclusion. When your employer pays the premiums for your accident and health insurance, that payment is deductible for them, and critically, it's excluded from your gross income as the employee.
That's a huge benefit right there.
It really is. Now, if you actually collect benefits from that insurance, those payments might be taxable income, unless they are specifically reimbursing you for medical care expenses you incurred, or if they are payments for permanent loss of use of a body part or disfigurement. There are specific code sections for that.
What about health savings accounts, HSAs? They seem really popular.
Hugely powerful tool. If you have a high-deductible health plan, your employer can contribute to an HSA for you. Those contributions are excluded from your income. Then the money inside the HSA grows tax-free. And if you take money out for qualified medical expenses, also tax-free.
Wow, triple tax advantage.
Exactly. It's fantastic. And it encourages people to be mindful of medical costs because any money left in the HSA can just keep growing, tax-free, effectively becoming a retirement fund specifically for future healthcare needs.
That's definitely a game changer for long-term planning. Okay, what about things like meals or even housing provided by your job? Can those be tax-free?
They can be, but the rules are very strict. For meals or lodging provided by your employer to be excluded from your income, 3 key conditions usually have to be met.
Okay, what are they?
1, it has to be furnished by the employer. 2, it has to be on the employer's business premises. And 3, it has to be for the convenience of the employer.
Convenience of the employer. What does that mean practically?
It means it helps the employee perform their duties better. Think of hospital staff needing to eat in the cafeteria to be available for emergencies, or a security guard needing to live on site. For lodging to be excluded, there's an extra requirement. The employee must be required to accept the lodging as a condition of employment. They can't just choose to live there.
So like the construction workers in remote Alaska example.
Perfect example.
Yeah.
Or a hotel manager living on site. It's not just a perk, it's often necessary for the job. If those conditions aren't met, the fair market value of those meals or lodging is taxable income. There are also some special rules for campus housing, for university employees, and housing allowances for ministers.
All right, now for the fun stuff, maybe. Fringe benefits, all those extras beyond salary.
Yeah, this is where it gets interesting for a lot of people. Fringe benefits are basically any compensation other than regular wages. And Congress has specifically excluded quite a few of them. For instance, employer-provided child and dependent care services. You can exclude up to $5,000 a year, generally. Qualified educational assistance from your employer covering tuition, fees, books for undergrad or grad courses, that's excluded up to $5,250 a year.
That education one is huge.
It really helps. Adoption assistance is another big one. Employers can provide assistance and employees can exclude a substantial amount. It's over $17,000 for 2025, even if your actual expenses are less for a special needs child.
Okay, what about things like cafeteria plans? I hear that term a lot.
Cafeteria plans, or flexible spending accounts, FSAs, are fantastic. They let employees choose between receiving cash salary or having the employer pay for certain benefits on a pre-tax basis.
Pre-tax, that's the key.
Exactly. So you might choose to reduce your cash salary by, say, $3,000 and have your employer put that into a health FSA. Then you use that $3,000 to pay for doctor visits, prescriptions, orthodontia, things you'd otherwise pay for with after-tax money. It stretches your paycheck further.
But there's a catch with FSAs, right? The use it or lose it thing.
That's typically true for health FSAs, yes. You generally have to incur the expenses within the plan year, although sometimes there's a grace period or a small carryover allowed. And there's an annual contribution cap, around $3,300 for health FSAs in 2025.
Good to know.
Yeah.
What are some other common fringe benefits that might fly under the radar?
Well, there are several categories. No additional cost services, think an airline employee flying standby on an empty seat. The key is the employer incurs no substantial additional cost providing the service, and it has to be in the same line of business the employee works in.
Okay.
Then there are qualified employee discounts. You can get discounts on your employer's products or services tax-free, but there are limits. For goods, it can't exceed the employer's gross profit percentage. For services, it's capped at 20%. Again, same line of business.
Right.
Working condition fringes are benefits that if you had paid for them yourself, you could have deducted as a business expense. Think professional license fees or job-related training paid by your employer. Since you could have deducted it anyway, it's excluded if your employer pays it.
That makes sense. What about really small stuff?
De minimis fringes. These are things so small that accounting for them is just unreasonable. Occasional personal use of the office copier, company picnics, maybe occasional meal money if you work late, small holiday gifts like a turkey.
Not cash, though.
Crucially, not cash or cash equivalents like gift cards. The IRS is very clear. Those are always taxable no matter how small. Another common de minimis fringe now is an employer-provided cell phone primarily for business use, where personal use is incidental.
Okay. Any others? Transportation.
Yep, qualified transportation fringes. This includes employer subsidies for mass transit passes, van pooling, and qualified parking. There's a monthly limit around $325 for 2025 for parking or transit passes combined. Interestingly, while employers often can't deduct these expenses anymore, they are still excludable from the employee's income.
Fascinating. Now, I heard something about non-discrimination rules applying to some of these fringes.
Yes, that's important. For certain benefits, specifically no additional cost services, qualified employee discounts, and also things like qualified retirement planning services, they can't discriminate in favor of highly compensated employees. Meaning, if the top executives get much better discounts or exclusive access to certain services compared to rank-and-file employees, then those highly compensated employees might lose the tax exclusion for that benefit. It has to be offered on substantially the same terms to everyone, or at least broad groups of employees.
So fairness matters for the tax break, at least for the higher-ups. Good to know. What about group term life insurance?
Another common one. Employers often provide life insurance. The premiums paid by the employer on the first $50,000 of group term life insurance coverage are excluded from the employee's income. Premiums for coverage above $50,000 are generally taxable income based on an IRS table. And note, this exclusion is only for employees, not for partners or sole proprietors.
Okay, lots of nuances in the workplace benefits. Let's switch continents. What if you're working abroad? Are you stuck paying taxes in two countries?
Not necessarily. U.S. citizens and residents are taxed on worldwide income. But there's relief. You can potentially elect the foreign earned income exclusion. For 2025, this lets you exclude up to $130,000 of income earned while working outside the U.S. To qualify, you generally need to be either a bona fide resident of a foreign country for an entire tax year or physically present in a foreign country for at least 330 full days during any 12-month period. It's a one-time election, though you can revoke it.
And if you earn more than that, or pay high foreign taxes?
Then instead of the exclusion, you might choose to take the foreign tax credit. This gives you a dollar-for-dollar credit against your U.S. tax liability for income taxes you paid to the foreign government. Often, if you're in a high-tax country, the credit is more beneficial than the exclusion.
Good options there. Now, back home, we hear about tax-free bonds, specifically state and local government bonds.
Yes, the interest you earn on bonds issued by state, city, county governments, possessions of the U.S., that interest is generally excluded from your federal gross income. It's a long-standing principle, partly based on intergovernmental immunity. It makes these muni bonds attractive, especially for people in higher tax brackets.
But not U.S. government bonds.
Correct. Interest on U.S. Treasury bonds, notes, and bills is subject to federal income tax, though it's usually exempt from state and local income taxes. Different rules.
Are there any special U.S. bonds for education savings that have tax breaks?
Yes, Series E savings bonds. If you buy these bonds and later redeem them to pay for qualified higher education expenses, tuition and fees, the interest earned can be excluded from your income. However, this benefit is targeted. It phases out based on your modified adjusted gross income, MAGI. For 2025, the phase-out starts around $99,500 MNGI for single filers. So it mostly helps lower and middle-income taxpayers save for college tax efficiently.
Okay. Beyond bonds, what about dedicated education savings plans like 529s or covered Ls?
Those are really powerful. Qualified tuition programs, or 529 plans, and covered L education savings accounts, or Section 530 plans, allow money to grow tax-deferred. And then if you take distributions to pay for qualified education expenses, the earnings portion of the distribution is completely tax-free at the federal level.
What kinds of expenses? College only.
Both cover post-secondary education. 529 plans are very flexible. Now they can be used for K-12 tuition up to $10,000 per year, apprenticeships, and even up to $10,000 lifetime can be used to repay qualified student loans. Covered Ls also cover K-12 expenses. The main differences are contribution limits. Covered Ls are capped at $2,000 per year per beneficiary and have income phase-outs for contributors, while 529s allow much larger contributions. Covered Ls also have age limits for the beneficiary, and there are also ABE-IL accounts, Section 529A plans for individuals who become disabled before age 26, offering similar tax advantages for disability-related expenses.
Lots of options there. Okay, tricky one. What if a debt is forgiven? Like a credit card company says, okay, you don't have to pay the rest. That feels like found money. Is it income?
Generally, yes. When you're relieved of a debt for less than what you owe, your net worth increases. That increase, the amount of debt forgiven, is typically considered taxable income from the discharge of indebtedness.
Ouch. Are there exceptions?
Yes. Thankfully, there are several important ones. Debt discharged in a Title 11 bankruptcy case is generally excluded. Debt discharged when you're insolvent, meaning your liabilities exceed your assets before the discharge, is excluded, but only up to the amount you were insolvent. There are also exclusions for certain farm debt, qualified real property business debt, sometimes when a seller reduces debt on property, certain student loan forgiveness programs, and a temporary exclusion through 2025 for discharge of debt on a principal residence. So while the general rule is taxable, these specific exceptions provide significant relief in many common hardship situations.
Okay, good to know those exceptions exist. Now, here's one that seems counterintuitive. The tax benefit rule. If I deducted something last year, say state taxes, and then I get a refund this year, is that refund automatically taxable?
Not automatically. The general rule is if you claimed a deduction in one year, and then in a later year you recover all or part of that amount, the recovery is usually included in your income in the year you get it back. However, the tax benefit rule, Code Section 111, adds a crucial condition. You only include the recovery in income to the extent that the original deduction actually gave you a tax benefit. If the deduction didn't reduce your tax in the prior year, then getting it back is an income.
Can you give an example, maybe with the SALT deduction cap?
Perfect example. The state and local tax, SL deduction, is currently capped at $10,000 per household per year. Let's say in year one, you paid $15,000 in state income and property taxes. You deducted the maximum $10,000 on your federal return. In year two, you get a $1,000 state income tax refund related to year one. Is that $1,000 taxable income in year two?
I would guess yes.
Not necessarily. Ask. Did the first $1,000 of the $15,000 you paid in year one actually give you a tax benefit? No, because your deduction was capped at $10,000 anyway. Even after the $1,000 refund, your actual SALT for year one was $14,000, still well above the $10,000 limit. Since the refunded amount corresponds to a part of the deduction that provided no tax benefit due to the cap, the $1,000 refund is not included in your income under the tax benefit rule.
Whoa. Okay, that's huge. So if your SALT payments were way over the cap anyway, your state refund might actually be tax-free federally.
Exactly. But if, say, you only paid $9,500 in SALT in year one, deducted that, and then got a $1,000 refund in year two, then $500 of that refund would be taxable because the deduction related to that $500 did give you a tax benefit in year one. It's about whether the original deduction actually lowered your tax.
That is a really important insight, especially with that SALT cap affecting so many people. So wrapping this all up, what does knowing about all these exclusions really mean for you, the listener? How can you use this information for better financial planning?
Well, understanding these rules really empowers you. Take life insurance. Knowing that you can potentially borrow against the cash value tax-free versus surrendering it and paying tax on the gain, that's a planning strategy. With employee benefits, it highlights the value of negotiating total compensation, not just salary. Having your employer pay for health insurance, childcare, parking, or education through pre-tax arrangements like a cafeteria plan effectively increases your after-tax income significantly. That's money you'd otherwise spend after taxes have already been taken out.
Right. The pre-tax advantage is key.
Absolutely. And things like the meals and lodging exclusion, if you qualify, mean you're receiving necessities as part of your job tax-free. For investments, knowing about tax-exempt municipal bonds or Series E bonds for education can shape your savings strategy. And crucially, remembering that many valuable exclusions like group term life insurance, HSAs funded by employers, many fringe benefits are available only to employees. That's a major consideration when deciding whether to operate as a sole proprietor or incorporate, or when comparing job offers.
Wow. Okay, we have definitely covered a lot of ground today. From the basic idea of what an exclusion even is, separating it from things that just aren't income, all the way through gifts, insurance, education, tons of workplace benefits, and that tricky tax benefit rule. It's really clear that gross income isn't nearly as simple as just looking at your paycheck stub. Knowing these exceptions can genuinely make a difference.
Indeed. Our goal was really to bring some clarity, maybe provide a few of those aha moments to show how these rules aren't just random. They're often designed to encourage certain things, provide relief in tough times, or just reflect practical realities of measuring income. And having this knowledge empowers you to look at your own income, your benefits, your financial choices with a much more informed perspective. You can start spotting where increases in your wealth might not actually be taxable events.
So as you go about your week, here's something to think about. How might understanding these tax exclusions change how you approach things, like negotiating your next job offer, thinking about the total compensation package, including those tax-free benefits, or how you plan for education or structure your savings? What other benefits or situations are going on in your financial life right now that might hold hidden tax advantages you haven't really considered before? Join us next time on The Deep Dive for another journey, making complex topics crystal clear.